Welcome to the Broken Pie Chart Podcast, episode 73. I'm your host, Derek Moore, and this week we're going to be talking about what should people getting started, what should people be doing who are just trying to, start accumulating assets, especially younger investors. And so if you're not someone who's younger, this is something that you can share with those folks, or maybe you yourself are just getting started. And so, quite often I get asked questions or I get emailed or, people know what I do and they say, hey, what exactly, if I want to get started, like what's the quickest way to make money? And unfortunately, recently there's been some stories about people maybe using leverage and using futures or options. And I've been involved, with managing portfolios and using options for, I think I'm going on, 26 years now. So I guess I would be considered a professional in the space. And I can tell you that if you are someone who's just starting out and you think that you want to trade options, there's a lot to learn there. And options can be used as a really good tool, but especially early on, I would not recommend, starting off with options. And the good news here is that if you look historically at markets and you think about like as a young investor, an investor getting started, or maybe, you're trying to do something in your 401k, there's sort of these, normally people say it's accumulation and distribution phases. And in the accumulation phase, you're trying to compile assets. You're trying to build up your accounts, to build up your net worth, those types of things. In the distribution phase, it's like, hey, now I need to start, I'm not working anymore, or for whatever reason, I don't have income, and I need to start to draw down these accounts, and that's the distribution phase. And there's any number of rules for that. We've talked in the past on the program about, the whole 4% rule. And the idea that, a lot of people look at, if you have $1 million, year one, you can take out 4%, which is $40,000. But there's also this third phase, which I think is often overlooked, but it's a really important one. And that's for someone who might be in their maximum earning years, might be in their 40s, their 50s, kind of looking at, at what point do they want to pull back, maybe not work as much, or maybe, retire, or do some other things. And I got to come up with a better name for it, but I call it the base maximization phase. And I'll put a link to a free chapter from my book, which actually talks about this stuff. And it goes through several different scenarios, both in average annual return. It also looks at contribution amounts, like how much you're putting in, any number of things. So I'll link to that in the show notes. And that's from my publisher, was nice enough to, one of the chapters, of course, Broken Pie Chart is my book, available on Amazon. That's not the only good part. There's other good parts, but I'll put a link to that as well. So when you think about like what it is you're trying to do, you're trying to accumulate net worth, assets, so that at some point you can have enough that you can stop working, or have enough that you can start to draw income or do some different things. There's good news here. The good news is that historically, the stock market has been a really good place. And it's been a really good place, if you read, and I'll link to his book, Jeremy Siegel's Stocks for the Long Run, sorry. One of the things he talks about in that book is, and he goes back, and there's some people who have critiqued that book as well. He goes back 100, 200 years and uses some averages. And let's be honest, most people don't have 100, 200 years. Obviously, you don't have 200 years. But over time, on a real return basis after inflation, a lot of the data in that book points to using stocks. And at the end of, I think it was early January, I did a piece that I'll link to. And I wrote an article and I put, a graph just, some bar charts. And one of the things I did was I showed the S&P 500, the total return, the compounded annual growth rate by decade. And remember, there's a difference between the CAGR, or compounded annual growth rate, and the simple average. And the easiest way I always explain this is, let's say you have $1 million, you lose 50%. Now you have 500,000. If you make 50% the next year, you're back to 750. You're not back to where you started. And so the simple average is, plus 50 minus 50 is 0%, but you're still down 25% on a cumulative basis. So the compounded annual growth rate, if you figure it out, it's about negative 13.4, something like that. I can't remember. I didn't do it before this broadcast, but that's your average annual compounded growth rate. And so the good news is, looking historically, there's only been, and I went back to the 1900s, there's only been 2 decades that had a negative return. And by the way, when I'm using total return, that assumes that you get the dividends. You own the S&P 500 index, which of course you can do with ETFs, right, or mutual funds, something like the SPY, or any number of companies like Vanguard and Schwab and all these. And iShares, they have these. But there's only 2 decades that were negative, and that was the 1930s. If you invested, January 1st in 1930, and you went all the way to December 31st of 1939, assuming December 31st was not a holiday, right? Last trading day, you would have had an average annualized compounded growth rate of negative 0.12%. So, it's a lost decade, but it's not incredibly negative. At the 2000s, so January 1st, 2000 through December 31st, 2009, you would have had negative 0.99%. So rounded, your average annual compounded growth rate would be negative 1%. Now, you might say, okay, well, those are lost decades. And in a second, I'll tell you the really good news, because most decades are pretty good. Remember that accumulation, distribution, base maximization phase? If you are in the accumulation phase, in a weird way, as you're putting money on a periodic basis into accounts, you actually don't want, let me rephrase this. Like, the market can reflect a good economy, growing, growing wages. You can talk about profits growing. But imagine if you started, just periodically investing, taking money out of every check, maybe like you do in a 401k, or you're just, doing it, and I'll talk about that in a little bit, on a periodic basis. You might be dollar cost averaging. That means, you buy systematically. But when the market's flat like that, if you're in the accumulation phase, that's good. In fact, you'd like to buy at much cheaper prices because you get to buy more shares. If you have a flat decade, that's problematic for the person who's 10 years right before retirement, because then they don't get that final, if you average 7.2%, the assets, would double over 10 years, right? The rule is 72. You take 72 divided by your compounded annual growth rate, and that's how many years to double. And then the distribution phase, it means as you're taking money out, you're not really getting any appreciation of the remaining assets. But during that phase, if you're a younger investor or someone who's looking to build wealth, those decades aren't that bad. The good news here is that, I'll just give you a couple numbers. I won't go through, I'll link to the article. But the 80s and 90s were, 17.6% compounded annual growth rate, 18.3%, respectively. And then the last 10 years, so not including this year, was up 13.33% positive, right? So you look at these decades, there's been 12 since the 1900s, and all but 2 were positive. And even the ones that, there was a 5.67, a 5.8, a 7.7. Most of those are positive, and that's really good news. So this is where we get into the power of compounding. People say, what's the value of starting to invest and starting to invest early? Well, I'll give you some numbers here. And I'm going to use some hypothetical numbers. You never know what you're going to actually get as your compounded annual growth rate. But let's imagine your current balance was $1. So you're starting out with nothing. And imagine that, I'll do this over 30 years. Imagine over the next 30 years, you put in about, $850 a month. Okay. And you might be like, I don't know if I can do that. Well, to give you some perspective, let's say if your salary was $60,000 and you put in 15% a year, that's only $750. I'm sorry, I shouldn't say only. That's $750 a month, or $9,000 a year. And you might say, well, I don't know if I could do 15%. Remember, a lot of companies have matches where they match up to a certain amount. It's a little easier than you think, to get to the 15%. But if let's say you did the 15%, and that includes, any matching, so maybe your contribution was actually less, and then you do an extra $100 a month. Let me give you the numbers here. 30 years, 7.2%, starting out with $1, putting in $850 a month, right? That could be 401k, that could be other ways. The compound annual growth rate winds up being a little over $1 million. In fact, $1,078,850. That's pretty powerful when you think about that. And that's the idea of compounding. That's just the idea of compounding, okay? Now, imagine, let's say, you're someone who's a little bit further along, and you're like, wait a second, I only have 10 years to go, but I have, $500,000 right now in my 401ks. I'm about 10 years to retirement, and you do the same thing. It's going to be pretty similar. In fact, over the next 10 years, you'll go from 500 to about 1.2 million. Again, assuming a 7.2% annualized growth rate, compounded annualized growth rate, and putting in that $850 a month. And remember, it's easier than you think, especially if you're contributing to a 401k and getting a match. But I illustrate that, and look, a lot of stuff can happen. There's no guarantees, of course, right? But I think it's really important to just point out just the power of compounding, the power of starting early. The more years you have, the better it is. But even if you never started, get started tomorrow. So what about dollar cost averaging? What does that mean? Well, dollar cost averaging just means that instead of buying something all at once, if you're periodically contributing money, the idea is that as share prices go up, you buy less of it. As share prices go down, you buy more of it. So imagine every month you're putting $100 in, and you're buying an exchange traded fund that holds all the stocks that are in the S&P 500. So you're indexing, you've got all these shares, right? You're diversifying. And, your 100, let's say that it's priced at 100. Well, if it's priced at 100, you're putting $100 in, you're buying a share at a time. If it loses half its value, it goes down to 50. Now you get to buy 2 shares. If it goes down to $10, you get to buy 10 shares. If it goes to 200, now you're buying half a share. And when you're doing funds and you're doing brokerage firms, and I'll talk about that in a little bit, you can actually buy fractional shares now. So the idea is that you buy less when it's high, buy more when it's low, and it helps you sort of average in over time. And a lot of people wonder, how would I even get started with that? Between Schwab and Fidelity and TD and Vanguard, and I'm probably missing a couple, any one of those firms, if you're starting out, is going to be fine, or if you know people. They're all good. They all allow you to, systematically draw money from, let's say, a bank account and have it invested at a certain time each month. It will happen automatically, and before you know it, you won't even know that it's coming out. You won't even miss the money. And they all have apps. They all, I haven't used all the apps. Like, for example, Schwab and TD, you can all log in and see that. But that's one of the recommendations I have for especially people who are looking to build wealth. Why not periodically on a systematic basis and have it automated? They'll do that for you. For example, Schwab will automatically deduct your bank account and put it into a fund that holds, Apple and Microsoft and any number of things. Also, interestingly enough, I think Fidelity's doing now, but Schwab has something called slices. So this is new. So you might think, well, I'm putting my $100 in a month and I'd love to buy Amazon, but Amazon is like $2,500 a share. I can't buy a share of that. What Schwab is enabling investors to do now is you can actually buy in $5 increments fractional shares of stocks. So in that case, if it's $2,500 for a full share, you could buy a slice, like a fractional share, like one whatever of 2,500. But I think their minimum is $5. So if you have $5, you can put it into Amazon, you can put it into Apple, you can put it into Exxon, any of the Schwab, the S&P 500 companies. And so, I think this is an interesting thing. Is it better than just periodically indexing or, choosing to put money into stocks, right? When you put money into a single name, you've got non-systemic risk. You've got individual name risk, right? If they miss earnings or if the CEO gets arrested, any number of things. But that's available now. It's never been more easy to do that. And so when you think about that, that's really, really powerful. The other thing that I would say is that if you're periodically investing and you're going into a fund or you're going into these fractional shares, is when stocks pay dividends, it might only be pennies, right? Or it might be substantial, depending upon how much you have. But I would recommend that you reinvest the dividends. What that means is whenever a company or a fund pays a dividend, they go ahead and they take that dividend amount and they reinvest it into however many shares, even if it's a fractional amount, if it's not a full share. And so reinvesting the dividends is another good way. So, there's, to give you an idea of that too, imagine, to go back to our example, imagine you had, $100 today and, you put only $100 a month into something and you're going to get, and we got to assume some type of rate of return. Here, I'll do the 7.2%. Again, it's not guaranteed, right? We don't know what market's going to do. But, over 10 years, $100 a month, you'll have $17,705 if you get, 7%. If you get 13%, like you got over the last decade, you'd wind up close to 25 grand. If you only got, 3%, you'd wind up with about, 14 grand over that time, right? And if the market went negative compounded annual growth rate, you wouldn't make anything. But again, you're buying on a systematic basis. So if the markets went down, you'd be buying lower. So, and I know some of you are like, that doesn't really sound like a lot of money. I'd be much better off just, putting my $100 into options, which cost a penny or something like that. I can tell you that's the probability of making money on those is going to be very low. There's real power in compounding, starting early, doing it systematically. And especially if you're doing it in a 401k, you're getting a match, or if you're able to up those amounts as you start to, increase your salary and things like that. So it adds up. And look, even, I've had people say, well, should I save for a vacation, or I want to buy a car and things like that. There's any number of things. Some people have, multiple pockets where they sort of earmark money for, and some people do a vacation fund where they put periodic, investments into one account, and they say, this is my vacation account, and things like that. So the reason I bring this up is I'm finding more and more, and I'm pretty, passionate about talking to people and seeing and trying to have them see the benefits of getting started. And here's the thing too, even if you're someone who's older and you've never started before, there's a lot of benefit. I mean, someone who's 50 and puts periodic investments again, you're going to have more money than you would have had if you hadn't done it, right? And there's real power in that. So, this episode, last two episodes, we had some guests on. I may have a guest on next week as well. But this is a topic I get asked about a lot. And the other good news too is that, places like Vanguard, TD, Schwab, Fidelity, right? They've got a ton of educational content on their websites. And if you, for example, let's say you went on Schwab's site and you wanted to open an account, like you can chat with them, you can look at their materials. But the things I think you want to look at are, how do you open an account? How do you periodically invest money into it? Meaning set it up so that money comes out of your bank account into your brokerage account. How do you set up a systematic investment plan or automatic investment plan, which is AIP? It's just a different form that you fill out. And then what happens is the money comes in from your checking account or savings account, goes to your brokerage account, and then they'll invest it on a certain day. And you don't have to do it once a month. You can do it twice a month. You can do it, there's a number of times you could do it. And check out those fractional shares too. Remember, if you're plowing money into one name, you've got, just understand where the risk is. But now, let's say you had $100 and you want to buy 20 different stocks at $5 each and kind of spread it out across industries and names. You can do that now. And with commissions at zero, now, it used to be if you bought one share of something and you paid a lot of commission, it would have to go up so much to break even, because when you buy it and you sell it, there used to be a commission each way. So I'll put some links in here. I'll put a link to the free chapter of my book, which has a lot of different models for different rates of investment, like different savings rates, different returns. You can you can see the difference, the power of, and here, I'll just do this one last one for you. Let's go back to our person who has, $500,000, right? And they say over the next, 10 years, they're going to put no money in each month, right? So if you got, let's say you get like 6% compound annual growth rate over 10 years, your 500 would grow to 909,698. Okay, good, right? That's good stuff. But then let's say you put in $500 a month, and this could be, again, in your 401k or something like that. Then you start to get not only the compounding effect, but then you also get the savings effect as well. You go from 909 to 991, so almost an extra. But where it gets interesting is, if you had the $750 a month, now it's $1.032 million. If you're doing $1,500 a month, $1,500 a month, or let's just do $1,000 a month. You're at $1,073 or so, and that's getting 6%, right? So I just bring this up because it doesn't matter. Like, even if you have assets, you should still make sure and contribute in the 401k. That's the easy one, right? But I'm a big fan of periodically contributing to investment accounts, and that way you dollar cost average, but make it automatic. I know well-intentioned people have said, I'm going to put an alert on my phone, or I'm going to put it on my calendar. It's too easy to miss putting the money in. It's so easy right now, automatically deducted into your brokerage account and have them automatically put it into a fund. Just choose, an index fund or something like that. Plenty of those, and those firms will help you out as well. So I'm going to call it good here. Again, if you like the episodes, or if you want certain content covered, or if you have an idea for a guest, you can start getting more guests on, since people seem to like those. Go ahead and I'll put the link to razorwealth.com and go ahead and contact me. And I like to get the comments and suggestions as well. Instead of rating and starring and reviewing all that stuff, go ahead and share this with somebody who you think might be interested, and especially if it's somebody who hasn't listened to podcasts. All right, folks, have a good week.